Welcome to The Explainer. Today, we are unpacking a topic that, let's be honest, is usually made way too complicated: the mechanics of value in financial markets. But here is the absolute best part, the secret nobody tells you. You actually already understand this. You participate in the exact fundamental mechanism driving global finance every single day without even realizing it. By the end of our time together today, you're going to view market charts through an entirely new, incredibly empowering lens.
Section 1. The most basic market, from everyday trades to global exchanges. Okay, let's dive into this. To really grasp the macro level of global finance, we have to strip away all the complicated jargon and start at the absolute micro level. Picture this for a second. You have an old smartphone just sitting in a drawer gathering dust. Now, someone in your city is actively looking for that exact make and model. You connect, you negotiate a bit, and you agree on a price. Cash changes hands, and they take the phone. Simple, right?
That interaction right there, you've got a buyer, you've got a seller, and you have an agreed price. That is the absolute most basic form of a market. It's an everyday exchange you've probably done dozens of times, yet it is the exact fundamental engine that drives the entire global economy. It really is that simple at its core.
Let's move to and see how this builds. We're going to scale that simple phone transaction up to a pretty extreme degree. Think about what happens if, instead of just two people sitting in a local coffee shop, you suddenly have millions of people buying and selling the exact same asset, like shares of Apple or US dollars, every single second of the day. I want you to take a mental 60 seconds and really ponder the massive structural problems that immediately pop up at this kind of scale. How in the world do millions of participants actually find each other? How is a fair price determined in literally the blink of an eye? And crucially, since you aren't sitting across a table looking them in the eye, who makes sure nobody cheats? I mean, these are massive logistical nightmares.
Section 2. Defining the financial market. 3 levels of understanding.
Well, to solve those massive logistical nightmares, humanity built financial markets. We're going to progressively peel back the layers of how they work, and we'll start with level 1. So fundamentally, a financial market is just an organized system where buyers and sellers meet to exchange assets at prices determined by supply and demand. It provides the framework so you don't have to, actually, scratch that. It means you literally don't have to wander down the street shouting that you want to buy a share of a company. The system does the matching for you.
Moving right along to level 2, we can see exactly how markets structurally solve those problems we just pondered. First up, we have discovery. This allows us to instantly find a fair price by aggregating everyone's opinions all at once. Next is liquidity. This solves the fast cash problem by providing an immediate buyer the exact second you need one. And finally, allocation. This ensures capital naturally flows to where it's actually going to be most productive in society. It's like a giant, hyper-efficient sorting machine.
So the crucial point is level 3. This is the professional understanding. Markets are essentially mechanisms for price discovery through continuous order flow. You have to understand, a chart isn't some magic crystal ball predicting the future. It is literally just recording a war between buyers and sellers in real time. Every single price you see, it's just the last agreed deal in that war.
Section 3. The never-ending auction. Supply, demand, and price.
To really visualize this real-time war, I want you to picture a never-ending, high-energy auction that runs 24 hours a day. The mechanics here are beautifully, perfectly simple. Step 1, if buyers think the price is too low, they step in aggressively, which drives the price up. Step 2, if sellers think the price is getting too high, they offload their assets, pushing it right back down. And step 3, when their forces are exactly equal, the price just moves sideways. That hidden, constant push and pull dictates every single chart you will ever look at.
Now, what's really interesting about this slide is the fundamental human reality hiding behind all these trades. People value the exact same thing completely differently at the exact same time. Think about a farmer who desperately needs cash today to pay his workers. He's more than willing to sell his harvest a bit cheaper right now to get that cash. On the flip side, a trader buys it, firmly believing it's going to be worth much more in 3 months. They both walk away winning, based entirely on their own unique perspectives of value and time.
And look, this isn't some modern concept invented by a bunch of guys in suits on Wall Street. As we trace the evolution of trading, we see this exact same mechanism created the very first ancient grain markets 5,000 years ago, and it is the exact same mechanism driving someone to frantically trade Bitcoin at 3 a.m. tonight. The technology changes, the speed is mind-boggling now, but human perceived value, that is completely timeless.
Section 4. The 4 major markets, where the world trades.
So where do all these continuous auctions actually take place today? Well, there are 4 major playgrounds. You've got stocks, where you trade company ownership during normal weekday hours. Then there's Forex, where massive global institutions trade currencies 24 hours a day, 5 days a week. We have crypto, which is the wild 24/7 arena for digital assets. And finally, commodities, for physical tangible goods like oil and gold. But here's the kicker. Despite their different hours and assets, they all run on that exact same core principle of buyers versus sellers.
Section 5. The Professional Trader Mindset, Shifting Your Perspective.
And this brilliantly illustrates the final leap we need to make. Understanding these mechanics is great, but to actually apply this, you need a massive paradigm shift. You absolutely have to move from a gambler's mindset to a professional's. A beginner looks at a chart with this kind of desperation, guessing and thinking, oh man, I need to predict where the price is going. A professional looks at that exact same chart with a cold, calculated focus, asking, where are buyers likely to be stronger than sellers, and can I position myself there with highly controlled risk? Your job is never to predict the future. Your job is to identify imbalances.
To wrap things up, I want to leave you with one final thought to really empower you going forward. Based on everything we just covered about that 24/7, never-ending battle of supply and demand, in this continuous auction, what exactly happens to the price when there are simply more sellers than buyers? Apply that logic, and you can start viewing the markets not as some random casino, but as a fascinating, real-time recording of human value. Thanks so much for joining me on this explainer, and I'll catch you in the next one.